All right, what's up, you guys?
Yo.
Hello. Thank you guys again for checking us out. This is my buddy Carlo. I'm David. This is Dollars and Cents, and we hope to make you dollars and make sense of the concepts that we're talking about in these episodes and in future episodes. So thank you guys again for hanging out with us. These are normally about 15 minutes long, these segments, but we want to jam-pack them full of information and try to keep steady on a particular topic so that we can really ingrain and really dive deep into this. And so thank you guys again. The concept or topic of this particular episode is going to be the overall financial strategy on kind of some of these different vehicles and ways that we're working on growing your money and protecting it. And so, we just want to kind of do a general outline, but, off the bat, and some of the bigger questions that we have is, when you're looking at some of these different retirement products, we are a big proponent of an IUL, which is an indexed universal life insurance policy. But how does that compare versus a 401k, a Roth, a regular IRA? And so we wanted to kind of, just dive over that and give the general overview, because limited, not limited, tax deferred, non-tax, tax-free, which is huge. And those should be big bullet points that are popping out to want to kind of dive and inform yourself a little bit more. So give us a general outline over those.
Yeah. The IUL is a vehicle, right? It's a tool, to build wealth if utilized properly. And we're using this non-traditional vehicle, right, by leveraging life insurance laws that really have special clauses in there that allow somebody to build cash value inside of these policies to be able to borrow from, right? So basically what rich people have been doing from the beginning of time, just finding those loopholes. But now we're just trying to bring this information to the masses.
And it's out there for everybody.
It's
right?
out there, right?
You just got to kind of dive
You
deep
got to. And hopefully you found this content. You're like, this is what I've been trying to look for, because they don't teach this stuff in school. Right. And anytime the government controls something, you got to ask yourself, is it for my best interest or theirs, right? So this is a government retirement plan, right? So anything that we call qualified, 401k, traditional IRA, 403b, 457, these are government programs that are based in Internal Revenue Code, right? So 401k, people are like, I have a 401k. 401k is a tax code, right? IRC, Internal Revenue Code 401k. There's 401a, 401b, right? These are tax codes, and there's restrictions on these codes, right? And we are starting now to realize a lot of these codes don't really benefit me with what I'm trying to do. Right. For example, 401k. It was created after pensions, right? So pensions, every company used to offer the employees pensions. You can do research on this. And once they did away with pensions, companies said, well, I can't afford to pay all these people an income for the rest of their life. So what if we do this 401k? And this is where Wall Street blew up, right? So Wall Street blew up in the 80s because now Wall Street said, man, we can make money investing all these employees' money in the stock market, right? And what you don't see in 401ks, you don't know how much. Let me ask you, do you know how much you're paying in your 401k right now? What are the fees? You're like, I don't know. I just contribute to it. You don't really know what the company is taking out of the top, okay? And plus, you have to keep that money in there until you're 59 and a half. So you may be 30, 40, and you're like, I got a few $100,000 in there, right? How does that benefit? You got to wait until you're 59 and a half. Well, what if I want to touch it early? 10% penalty on top of income taxes.
I thought, and then correct me if I'm wrong, but you also, after you hit that threshold, you can't necessarily just leave all your money and continue to grow. There are minimum withdrawals that you have to take from that as well, right? They make you withdraw that money.
It's called RMDs, or required minimum distributions, right? They now moved up to age 73. So that means if you do not start taking out money by age 73, they penalize you for that.
Right.
So why? Because they want their tax money off of your money.
Right.
Okay. So again, these are vehicles that were mostly predicated towards middle class America. Wealthy people said, I'm not playing that game. And this is where life insurance comes in. And we've been trying to take these games that the wealthy have been playing and say, how can we all get this information so we could all play?
Mm-hmm.
This is where the game of permanent
Play
life
on,
insurance
play
comes from, right? So first thing, leverage, okay? In a 401k, most people, you're a real estate, right? Most people, how do they come down with that first, I need to come down with 20% or a down payment on my property? They typically will let you borrow from your 401k, okay? Or people just borrow from the 401k in general. The downside of that, right, is when you borrow, it's tax-free because you're taking a loan at, but it must be paid back.
You have to pay it back.
Typically within 5 years. You got to pay. So you got to start paying back that money, and it has to be paid back within 5 years. In an IUL policy, when I borrow from that, it's also tax-free, just as is 401k, also tax-free.
You got to pay it back.
But I don't have to pay it back.
Right.
I have the option to pay it back. Well, Carlo, what if I don't pay it back? How is that loan paid back? It's a life insurance policy. You have the death benefit, right? So the death benefit of the policy will cover the loan when I pass away, hopefully many years from now, as long as I play within the lines, right? And I don't over leverage the policy. So when people take policy loans, I say you probably shouldn't take 100% of the equity out of the policy, because the policy could blow up if there's not enough cash value to be used as collateral. So like a house, I say take at least 75%, maximum 80% loan to value of your policy. No credit checks, no monthly payments, 100% tax-free. And that's how you can go make that money work for you times two somewhere else.
This is a wealth building tool. And so it's important for y'all to remember on why you're going to use this money. And this money that you have in your cash policy is not to go fund a vacation, or it's not to go buy a Cybertruck. It's for you to reinvest that money and be able to get a return on investment, and capitalize on that spread and that yield and the whatever. But there's a reason why you're going to be pulling out this money, is because you want to have it continue to grow.
Yes.
And so it's important to think about that. And so we talked about this, and some of the ideas that you can use this is, obviously purchasing real estate was ideal. Granted, I'm a realtor, so I will be saying that as my number one. But let's be honest, historically, real estate is going to give you the largest return on your potential investment. So, real estate is great. Reinvesting that into stocks, as long as it's done correctly, can also build money off of that particular investment. Crypto, which you and I are very big about, and we will be touching on that in the show as well. Why don't we touch on that really quick? Because it's something that's on the top of your head, recently.
All the time, yeah. I mean, cryptocurrency, obviously, we know is an asset class right now that is emerging.
Do your own research first.
This is not
financial advice.
Now,
right?
please, full disclosure, right? Because I see it in the comments already. All the regulators coming at me. He just told me to get an IUL and borrow against it, go put it in crypto. I am not telling you to do that. Okay. But what I'm saying is, the way these policies are best utilized is, if you're going to borrow from it, you got to know how to invest.
Right.
Okay. So just having an IUL is 50% of the game. If you're going to use the policy properly and leverage it, I mean, I'm going to borrow the insurance company's money, that if there is an interest rate of 1 to 5%, it's very important that you know how to go flip that money and earn more interest than what the insurance company is charging you over a period of time. We leave that to you, right? Or if you need some guidance, obviously come talk to us. That's what we're here for. But it's important that you put that money into another asset class, right, that is going to earn more yield
than what you're being charged.
Which is exactly what the bank is doing with your money, right? The bank is doing it. The bank is literally saying, hey, we'll pay you 1% on this money, David, knowing that we're going to go flip it for 15 to 20%. They're making the spread. Why can't you go make the spread?
Truth be told, the concept is not really a hard concept. As long as you have a good grasp on what direction you want to go with this, the concept is fairly easy. You're getting charged X amount, but you're going to make this much more. That's called the spread. You get to keep that, and that's how you grow your money.
Yes.
Cryptos is another way, and reinvesting this money into your business is another way.
Yes.
What that looks like, growing your business, buying a building for your business, that's making money, right? When you're able to buy the building that you're in instead of leasing it from a property manager, that's how this can help you grow your business, or reinvesting it into your employees or whatever. But there's different ways and concepts, but you have to be smart about this. And you have to educate yourself, really, and that truth be told. And hopefully this show will give you these ideas, or at least spark your interest on wanting to learn more. Myself and Carlo can help you understand and really get a good idea and a good grasp on how you can do this. But it's really going to take you all to take that first step and want to learn. But I think it's important, and I have it written down. As long as the ROI, which is a return on investment, is larger than what you are borrowing it against, then this is how these strategies work.
Yeah. Okay, do we got time for a quick story?
Yeah, absolutely.
So one of the best use cases for IUL are real estate investors, right? And I learned this, right, because I was not in real estate to the degree that this guy was in. And he's like, this IUL policy makes total sense for me. Okay, this guy's putting $75,000 a year. He buys and flips homes in Ohio. And he borrows from these policies like in the 30s, 40s, 50,000s, pays the loans back, right? Borrows from him again. And I said, man, he borrowed he took a loan recently and the net rate was 1% loan. So he borrowed about $40,000 at a 1% from his IUL policy. And I said, mind you, he's got the collateral amount over here still earning interest, right? He's borrowing the insurance company's money. And I said, okay. He's like, I'll pay this back in 6 weeks. I'm like, wow. If you don't mind me asking, how much are you going to make on that $40,000? He's like, 60%.
Mm-hmm.
So 1%, right? Loan rate versus a 60% return on investment.
59%.
Do the math on that, folks. I'm like, wow. Okay. He's like, this is a turbocharged. Right. So he's like, before, he used to have to take hard money loans.
Hard money loans, which are double digit
12% interest rates. He's like, I was paying 12%. Then I have to pay monthly as I'm fixing and rehabbing the property in order to flip it. Now I can borrow from this policy without no monthly payments, right? And I can pay it back or not pay it back. Right. And my money is still earning interest, right? All day.
I just go back to the idea of, as long as you get the general outline or the concept of how this works, it's all math, simple math. Quite honestly, when you break it down, and as long as you're making more on the money than what you're paying, which, anywhere between 1% to 5%, you should be sitting pretty.
Yeah. People were doing that with this high interest rate environment that's now changing, unfortunately. Right. But you could go take a 1% loan and just put it in a CD and make 5%. You're making more. You're making 4% arbitrage.
Buy metals,
right?
buy gold. Especially in the type of environment that the U.S. is headed. You want to be able to protect yourselves in various ways. And so I'm all about diversification. And so there's different ways to go about this. With that said, though, I think it would be important for us to touch on the fact that, if you're new to this concept, it's easier for somebody to start small and work their way up to a larger account versus the flip side.
Yes.
Talk to us about that.
Yeah. Start where you can. Right. And again, I recommend at least a minimum of 10 times your age. So if you're 40, at least 400. If you're 50, 500, and be committed to doing that at least 10 to 15 years. Mm-hmm. You can always increase, right? And there's a lot of flexibility. It's got to be designed properly. Mm-hmm. And let me just cover those really quickly, right? These are the 4 things you got to know before you purchase an IUL policy. Mm-hmm. Number 1, structure and design. Mm-hmm. You need to know that your policy was structured and designed properly, and your agent or advisor should be able to break that down for you. Number 2,
he means us.
You should know the cost and fees. How much of my monthly contribution is going towards the cost versus how much is going towards the cash value? You should know that to the dollar. Number 3, how does my policy perform? What interest has it generated? What is the track record of this company? And number 4, which I believe is probably the most important, is what are the loan rates? And are those contractual? Because when you borrow from the policy, you need to know what rates you're getting at, because that's going to determine if you can arbitrage it and earn a higher interest rate than what they're being charged.
That's a great way to end this particular segment. But I think asking those 4 questions to whomever you speak to is going to give you a good baseline to work off of. And if they can't really even answer those questions for you, or give you a straight answer, then maybe that person isn't the right.
Maybe you should call Carlo and David, right? And schedule a complimentary consultation.
For sure. You guys, we're at the end of this episode, and thank you all again for hanging out with us. We really, truly appreciate it. And we hope that we know that you will find value in this episode and ongoing episodes. But we just appreciate all your participation, and we continue to look forward to growing with you and just being a service to you all out there. So thank you guys again. On behalf of Carlo and myself, thank you for hanging out with us. This is Dollars and Cents. Peace.
See you later.
Yeah.
How's